Okay, we have another example of the consolidated statement of profit and loss, and this one is again slightly more difficult. What we have here is the same parent and subsidiary relationship. The parent owns 100% of the subsidiary, so there's no NCI to deal with in this example. But what we have here is a very common occurrence, that the parent has sold inventory to the subsidiary for £2,000 during the year. The margin for the sale was at 10%. So the parent has sold goods to the subsidiary at a profit, and the subsidiary has sold all this inventory on by the year end. Now, what's going on here? The parent has sold goods to the subsidiary at a profit. Now, when we consolidate the two companies as if they were one, it can't really make profit from itself. So we have to reduce the statements by the profitable amount. Now, what's happened here, though, is that the subsidiary has sold all these goods out of the group by the year end. So the profit margin that the parent had added on has actually been sold on by the subsidiary, so we can include the profits. Now, this is the key point. If the subsidiary has any goods left, then we have to make a small adjustment. But what we need to do now is just remove the inter-entity sales. So what happened? The parent sells inventory to the subsidiary for 2,000. So we need to reduce this figure, which is the revenue figure for the parent, by 2,000. And we need to reduce the cost of sales, the cost of goods of the subsidiary, by the same amount, because the parent has sold to the subsidiary. It's 100% owned, and when we consolidate, there's no point making a profit out of yourself if you're in the same group. So now we are ready to rock and roll. We have exactly the same process as previously. We just add across all these numbers. So we've got the parent amount. We need to add in the reduction on the revenue, which was 2,000, and we need to add in the subsidiary revenue. So that now gives us 35,000, whereas previously it gave us 37. Same here. Cost of sales and expenses, 1,000. Add on the subsidiary's cost of sales. Oops. And we also need to add on the adjustment. Add on the adjustment of the 2,000 inter-entity sales. So that's 1,000 plus 5,000 minus 2,000, 10,000, 15,000 minus 2 is 13,000. And that's the difficult bit done. We can just do the profit as revenue minus cost, 48,000, and the rest is exactly the same as before. Dividend from the subsidiary, we know not to include that, so that's just 0, which means our profit before tax is the same as the profit from operations. These is exactly the same, no changes here. Add across income for the parent and income from the subsidiary is the same. Means the profit after tax is just the same as the profit before tax minus the tax, minus the tax. The dividend, as before, parent only. That's the dividend going out of the group, is only 1,000. No NCI to deal with in this example. So that means the retained earnings are 41,000 minus 1, 40,000. Now, that looks like an awful lot. It looks like I've made a mistake somewhere. 35 plus that, plus that, plus that is 12. That's 13. There we go. Looks like I've added those two together. So always worth going back, checking your work, seeing if it makes sense. How did I know that was a problem? If I just put that back again, I've got here a consolidated profit of 40,000, and the two entities on their own only had a profit of 14,800. So obviously I knew there was a mistake. Quickly recast, and this was the obvious error. So revenue minus the cost of sales this time gives 22,000. That makes more sense. Gives us a profit of 14,800. Let's just review what we've done here. So we've got the parent plus the subsidiary less the adjustment. In fact, I'll put the adjustment in here. Less the adjustment plus the subsidiary. And here the P plus the S minus the adjusted cost of sales. So the sale went from the parent, so we have to reduce the revenue of the parent, and it went to the subsidiary. The subsidiary bought the goods, so we have to reduce the cost of sales, the cost of the goods they bought during the year. And that comes to a round figure of 25 minus 2 is going to be 23, plus 12 is going to be 35. So that makes sense. And this is 10 plus 5 is 15, minus 2 is 13. So that all makes sense to us. And the rest is exactly the same as before. Ignore the dividend. Profit before tax is just a simple calculation. In fact, it's 22,000 minus 0 is still 22,000. The income tax expense is P plus S. P plus S, which gives a profit after tax calculation. The dividend is, as before, the parent only, and then that gives us retained earnings of 14,800.